How does settlement differ for calls and puts? Have you ever wondered how settlement works in options trading, especially when it comes to call and put options? Understanding this concept can really help you navigate the stock market. Let's break it down simply. When you buy a call option, you gain the right to purchase the underlying stock at a specific price, known as the strike price, before the option expires. If you decide to exercise this call option, the seller, also known as the writer, must deliver the shares to you at that strike price. This means that if you hold a standard equity option, you will receive 100 shares per contract. The seller is obligated to sell these shares, either from their own holdings or by buying them at the current market price if they do not own them. On the other hand, when you buy a put option, you have the right to sell the underlying stock at the strike price. If you exercise this option, the seller must buy the shares from you at that strike price. This requires the seller to have enough cash or margin set aside to cover the purchase. So, in this case, shares are transferred from you, the put buyer, to the put seller at the agreed strike price. Now, it is important to note that if neither option is exercised, meaning they expire out of the money, no shares are exchanged. The buyer loses the premium they paid for the option, and the seller keeps that premium as profit. Additionally, some options settle in cash rather than through the physical delivery of shares. Cash settlement occurs when the option's value at expiration is determined by the difference between the underlying asset's price and the strike price. Instead of exchanging shares, the net amount is paid in cash. This method is more common with index options or certain binary options, but is less typical for standard stock calls and puts. To sum it up, the settlement process for call options involves the seller delivering shares to the buyer, while for put options, the seller buys shares from the buyer. Both situations requiring the seller to fulfill the contract terms at the strike price, with physical delivery being the standard method unless cash settlement is specified. Understanding these differences can help you make more informed decisions in your options trading journey.